The Fed raised rates again for its 11th time. This marks the 22-year high in interest rates. And what we're going to see next, a credit crunch and loan defaults. In this video, we're going to talk about what these rate increases are going to mean for both residential and commercial real estate. So what is going on with the Fed? They've raised rates 11 times. Single-family housing is not going down. However, commercial real estate is going down hard. Why is there such a difference? So as we all know, inflation got out of control last year, and the Fed is adamant in raising rates to try to lower that number. So after 11 rate increases, both the price of housing and the price of rent has not gone down. What has gone down are the values of the commercial properties, which we're going to focus on now. So the first slide we're going to talk about is the office market, which represents about 15% of the $20 trillion commercial real estate sector. So the office market right now does account for about 80% of the commercial loan delinquency. So everybody's talking about this right now, which makes a lot of sense because many of these office buildings are suffering from work from home, and the landlords are getting killed because the vacancies aren't supporting both the expenses and the debt. One thing to note here is that much of this office building is suburban, with the urban core, the Class A properties. They make up less than half of all the United States office space. But for purposes of this video, I want to focus on multifamily. So multifamily represents about 18.45% of the $20 trillion commercial real estate market. So multifamily is the largest category, exceeding even office. So there are three things that happen in the multifamily market that many of you may or may not know. Number one, there were a lot of loans originated in 2020 and 2021 when rates were very, very cheap. Number two, many of these loans were either bridge loans or construction loans, which means that these loans were temporary or bridges, that they were short-term and they reset in 2 to 3 years, and they're all going to be facing higher rates. Number three, the majority of these loans are with small and regional mid-sized banks, which originated over 50% of all of these loans. So multifamily is in a much different scenario than office, where office is suffering from vacancy, multifamily is not. What multifamily is suffering from are these loan maturities that are starting to hit this year, which we're going to talk about next. So in this chart, we talk about debt maturities, specifically for the apartment industry or multifamily. These are commercial mortgage-backed security loan maturities that have already started to hit or are really going to hit in Q4 of 2023. And you can see how they roll out through most of next year into 2026 and 2027. Why is this important? It's important because the Fed is continuing to raise rates, and every single one of these lines represents an apartment community that has a low interest rate from prior to 2021. And when these mature, many of the values of these properties are not going to be worth the loans themselves. So I'm calling Q4 of 2023 Red October. When you can see here, which I circled, there's $8 billion of multifamily commercial mortgage-backed securities, or CMBS, which is expecting to come due starting the second half of this year. This is exactly why I'm telling you guys to hold on to your dry powder, build your reserves, and get ready, because this $8 billion here is largely going to go back to the lenders. A lot of these syndicators and a lot of these landlords are not going to be recapitalizing these properties, and they have no chance to refinance these properties. The values of these properties, in many cases, are actually worth less than the loans themselves. This is going to be very disruptive to the banking system, and it's going to ripple through to the single family. And of course, at the same time, we have many of these commercial office buildings that we mentioned earlier also defaulting around the same time. And what's really important to understand here, guys, is somebody's holding this debt. It might be a life company, it might be a pension, it might be an insurance company, it might be a regional bank, but somebody owns this debt. And when that debt matures, they're going to have to right-size this loan, which means that much of the equity in a lot of these properties that existed just 1 to 2 years ago is going to be gone. So let's take a deeper dive here. And so many of you might have heard about debt service coverage ratio, or DSCR. But a debt service coverage ratio simply measures the ability of a borrower to repay its debt. That's all it is. And the debt service coverage is widely used in commercial loan underwriting and is a key formula that lenders use to determine the size of a loan. So if you're getting a loan, typically what a lender will do is they'll have a debt service coverage ratio in the loan document. In other words, the debt service coverage ratio is almost an insurance policy for the lender. So these debt service coverage ratios are going to be talked about a lot. And debt service coverage is simply the annual net operating income divided by the total debt service. We all know that total debt service has gone up. So in this equation, the debt service coverage is actually going down because the debt service has gone up. Not necessarily because the net operating income has gone up or down. That's all because of the debt service, because the price of debt continues to go up. So these debt service coverage ratios are actually out of balance if you're a lender. And they're concerned, of course, and they're asking the borrowers to put up more cash or more reserves. And some of these borrowers are deciding that's not a good idea right now because the value of our properties are less than the actual loan themselves. As you can see in this slide, the debt coverage ratio below 1 means that the property does not generate enough revenue to cover the debt service, while a debt ratio over 1 means the property should, in theory, generate enough revenue to pay off all the debts. So it's very common for lenders to have a requirement of a debt service coverage of 1.2, 1.25, or 1.3 or more. But in many situations, we're starting to see that these debt service coverages are actually below 1. So this is the canary in the coal mine. What's happening is as these properties get right-sized and as these loans mature, the lenders are going to rely on the debt service coverage ratios. So even if the syndicator or the property owner is meeting the net operating income number, the total debt service is for sure much higher because rates have gone from, say, 3 to 5 or 6%. And therefore, the debt service coverage ratios are below 1. So what happens when a debt service coverage ratio goes below 1? Well, the lender is going to lend less. In other words, the borrower or the syndicator is actually going to have to do a cash in just to hold the property because a refi right now, as you all know, does not exist. Nobody's going to refinance from 3% to 6% without some kind of a cash-in refinance. This, of course, is going to be the biggest issue facing many of these commercial real estate assets. So those of you who are in residential, you may not care about this, but what this is going to do is actually going to spill over into the residential market because big banks that service residential, like Wells Fargo, like Chase, like US Bank, they all do business in the commercial real estate sector and they do business in the residential real estate sector. Toxic debt in one part of the bank is going to contaminate the entire bank. It's going to affect all the underwriting, and it's actually going to be tougher and tougher and tougher on the real estate industry, no matter what sector you're in. While multifamily is actually performing from an NOI standpoint, it's not performing when you're looking at the cash-on-cash reserves because the debt service has gotten so high. Much of that cash that originally was projected does not exist today. What it really means is that if your loan is maturing based on the loan maturities by month through 2025 or 2026, and rates don't go down significantly, then most of these real estate assets are not going to be worth the value of the loan. Therefore, most of the equity could be completely gone or eliminated. If you're in a position where you don't have a loan maturity for the next couple of years, you very well could be fine. But today, if you are maturing and the loans are at 5 or 6 and your rate was at 3% and your debt service coverages are less than 1, which in this particular case they would be, that means that the bank is going to give you less of a loan on the refinance and you're going to have to write a check for the difference of the old loan versus the new loan just to keep the property. So this is the ripple effect for when the Federal Reserve continues to raise rates, it actually increases the cost of debt, lowers the debt service coverages, and will put many of these assets into default and wiping out everybody's equity and even potentially taking a loss for the bank itself.